All right, I want to welcome everybody. I'm Jim Farish from jimsnotes.com. So we're starting a whole minute early. We're going to punish everybody who's late. I just want to remind you, if you have questions, feel free to ask the questions. I'll try to juggle in between the two to answer whatever questions you have. Tonight we're going to kind of wrap up what we've been talking about for the last 3 weeks, and I'm going to go back and kind of go through Scan, Watch, and Play. But more importantly, I think one of the things that when I was putting this together, when I started thinking about this, one of the questions that I always ask myself relative to trading, investing, or managing money, whatever you want to call it, is, you know, a long time ago I read a book, and one of the first things in the book was about building a business. This was probably 30 years ago. And one of the first questions is that in the book that was asked was, why do you want to start your business? And that's always kind of resonated in my mind, even with trading. And so tonight I'm going to start with that question, is that you've got to start with why, and that is, why are you doing this? First of all, why are you managing your money? Why are you trading? Why are you investing? Why are you buying a specific stock? All of those questions come into mind every day. I mean, today my question this morning was, why did the market open down at the open? And I find it interesting and humorous at the same time, in that Ballard could make a comment about rates starting to hike interest rates on the Federal Reserve in March of 2015. We're in June of 2014, so we're essentially 9 months away. And the market reacted to that at the open. At least that was the description as to why the market reacted. But when it was all said and done, the market came back and the buyer stepped into the market and bought it back. And I want to start with things like this, because I find them humorous, in that if we look at the intraday chart, my question at the beginning of the trading day is why? And we've talked about this over and over again in these last 3 or 4 webinars, and this is the personality of the market today. So this is what personality the market's going to take on, is a reaction to an event, and that event was the Fed making a comment. And so what you have to ask yourself, if you're trading intraday, is there an opportunity in that? And if so, what? And how can I capture that? And if you're not a day trader, then it's a non-event. Then you just kind of go on to the next thing and ignore it. So you have to learn to filter what you're doing relative to your strategy. So the question that we're going to start tonight with is, why am I doing this? And so why am I trading? Why am I investing? Now, I've been an investment advisor for 30 years, and one of the first questions I always ask a client, prospective client, when I sit down and talk to them is, what are you trying to do? And we talk about that, and then my question is, why? And the answer that I get, I will say 95 out of 100 times, is I want to make money. In other words, what their ultimate objective is to make money. And to me, that's a nebulous event. I mean, it's almost inconsequential. And that if you don't have a defined objective as to why you're doing this, it becomes you get focused on this. I mean, you get focused on this symbol, is that what is the return on investment? And if it doesn't match what's in your brain, then you tend to self-destruct, and that becomes, I think, self-defeating. So there's a lot of psychology that goes into trading. If you want to make money, it's not about this. It's about whatever that is. If you want to pay off your house, then that, to me, is a concrete objective of whatever it is. If you want to buy a new car, I failed art, so you'll have to, plus I'm drawing with a mouse, so it makes it worse. If you want to buy a car, if you want to, send your kids to, which I have to worry about this right now. One of my daughters just graduated from high school, so now she wants to go to college, and we got to pay whatever that's going to cost us, $20,000 a year for college. So all of these events come up, and they all need money. And when it becomes a concrete objective as to why I'm trading my money, it becomes a lot easier to enact what we've been talking about really over the last 3 weeks, which is scan, watch, and play. How do you manage events in the market? How do you manage the personality of the market? All of these things become, to me, a lot clearer. And you say, well, you know, I'm old, I don't have all of those things that I have to worry about, but I do want to, you know, focus on where I'm trying to get to relative to my objectives. And so as I blow up what I'm trying to do here, let me do this real quick. So when I look at this, one of the things that I'm constantly worried about is how do I manage money from a standpoint of getting where I want to be on a day-to-day basis, and then how do I achieve what I'm trying to achieve on a day-to-day basis. And that really comes down to how you manage money all the time. So where we are right now is focused on putting things into play relative to what I need to achieve every day. Now, if I have a client who walks in, and I have clients that I met with just a couple days ago, they're retired. What do they want? They want income. So they need an income objective. So let's play out a scenario that I've played out, I think, about 1 million times in my career. And let's say that you're 10, so I want to retire. So that's my objective. I want to have income at retirement. So you can use this. If you're already retired, you can back into the numbers the same way. If you're not retired, you back into the numbers a different way. But you say, I'm 10 years from retirement. I've got $500,000 already accumulated. So when I look at this, and I'm going to write on this, so I have $500,000 now, and let's just say in a 401k. I want to have $60,000 a year of income from that money, and I've got 10 years to retire, and I'm saving $800 a month into my 401k plan. So I have, and then I get matching of, say, 25%, so I get an additional $200, or a total of $1,000 a month is going into that plan. If I take that and I say this is the objective, I can back into that number very simply, and you can go about it. But if I just took this parameter and I said that I want to make 1% a month on my money, or 12% per annum on return on investment, then at the end of 10 years, this would equal $1,880,000, which at 5% of income off of that, or a trailing stream of income, that would be $94,000 a year minus my taxes. I would generally assume that I'm going to net out $60,000 a year. That's why. So in other words, if that's my why, so we're at one of two places. We've either accumulated the $1.8 million and we want to manage that money to generate the income, or we're in the accumulation process and we need to manage the money to get to the objective. So the why now will drive the assets. And as I go through this tonight, we'll talk a little bit more about different components of this. But I want to go through one that's kind of near and dear to my heart right now, is that my daughter's getting ready to go to college. All right, so she starts the end of August at Florida State University. I know that it's going to cost me right now $12,000 a year, plus an additional $6,000 for living expenses on top of that. So I need $18,000 a year. She has an education trust fund today that has just right at $100,000 of income. That means that if I want to preserve the $100,000 so Dad gets to keep what he saved, and I can pay the $18,000, then I need to earn 18% on my money. Or if I take this and divide it by 12, I need to earn $1,500 a month to pay for school. And I can take that $100,000 and I can now manage it. And on the website, we've talked about the egg. We've talked about different things that we can do. But we can manage that money truly based at that objective. And let me tell you what will take place is you become a much more disciplined investor. You take profits where you should. You take losses where you should. You don't mess around because you know that every 30 days I'm going to generate this. And what I find is the longer the time frame from here to here as far as the objective, the more lackadaisical we become with it, which is why people have a very hard time managing retirement assets, is that they don't, I mean, if they say, well, it's 10 years down the road, we think 10 years down the road. We don't think, what do I need to do today to manage that process or that asset? So start with the why, put it into place, and then start managing the asset to get to where you want to be versus trying to manage the market. I think this is where we get in trouble, is we try to manage the market. And what we're really trying to manage, my view, what I'm trying to manage is lifestyle. In other words, I'm trying to manage what I want from my money and not so much what so if I'm trying to manage my lifestyle and I'm looking at the S&P 500 going up, and I know, because I do this every day, I know that XLE is one of the components that's driving to the upside, and I know that the semiconductors is one of the pieces that's driving to the upside, and I know that software is driving, and I can dig through this, and I know that XLV, and out of that I got the pharmaceuticals, and I got biotech, and I know what's driving the market. All of these are investing them are based on providing me the lifestyle that I want. So when we talk about putting together portfolios and managing the process of a portfolio, it really comes from why. It's why am I doing it? Because if why I'm doing this isn't big enough or understandable enough, the how will become nebulous. In other words, it becomes irrelevant. And that fact that you can manage money any way you want. If you're trying to beat the market, I guess my feeling is good luck. Knock yourself out. I'm trying to manage money where what I have invested becomes real and not ethereal, so to speak. And I think we talk too much in theory, we manage too much in theory, and we try to focus in the wrong way of getting there. And so every day when I walk into my office, my focus is, what do I need to get to where I want to be with my money? And then if I have a client, I'm going to look at what do they need and what do I need to do to provide to them to get to where they want to be with their money. So what it all boils down to is you decide on what, which is how you're going to manage the money based on the why. So what you're going to do really comes down to what you're trying to accomplish. So with that, let's get into kind of a recap of what we've kind of covered the last 3 weeks and what we're going to kind of go through tonight, which is controlling all of this process. In other words, it's taking from soup to nuts how we're going to run scans, how we're going to build a watch list, and then how we put the portfolio together so that we accomplish the objective for which we set out to do. And that's really what all of this is about on a day-to-day basis, is really trading on purpose. In other words, knowing why we're doing it, trading on purpose, and accomplishing our objectives. So because the easiest thing for me to go through is the egg, I'm going to go back to that tonight, and then I'm going to go back, and then I'm going to come back to the S&P 500 model, because I want to talk about one that's longer term versus one that's short term, and how do you put them into transition. And tonight, when we go in and we run the scans, we don't own an egg right now. We had TAN was the actual piece that we owned. Let me get on a different chart here. I don't like candlesticks. But if we look at TAN, we did own TAN. We wrote it up, and then we got stopped out on this bar. We sold part of it on this bar, and we got stopped out on this bar. But what happens is now it's right back up into this trading range, and we'll see what happens with it. But I haven't dismissed it. But since then, we've been running the scans. There's a couple things that interest me. One is China. And China interests me because of this sell-off back to the 30-day moving average. Let's just use FXI just because it's non-leveraged. And when you look at China, one of the interesting things to me in the filter is that China keeps coming up. It pops up and then it drops out. It pops up and it drops out. And it dropped out of the scans off of these two bars. It came back into the scans today. And so these three bars, China sold off. So it sells off, it catches support, and now it bounces. Now, if China follows through tomorrow, it may be very well that we look at buying China as the egg, as a component that is in that position that really has upward momentum. And the question really would beg, why would you buy China at this point? I think a lot of things. One is that China came out either based on the fact that they're a day ahead of us. They came out basically 2 days ago and said, we believe that we got to put more stimulus into the Chinese economy. They want to strengthen the yuan. China's got its own agenda. So China's willing to do some things right now to kind of stimulate things and get things going. And I think that China could pop. So that's one of the things that I'm looking at right now. So if I run my scans, it comes up on my scans, and now I'm going to watch it. So I scan, and I'm just abbreviating this so that we can get to the end of the road here. And so FXI becomes what I want to watch. I now have to define where would I buy this. And to me, let's just say it's right in through here. Let's use 37.25 as our entry point on FXI relative to what we're seeing. So we got scan, watch, and play. So the play would be an entry at 37.25. We'd want to stop out of the position right in here. If it violated the low here, obviously you want out of the position. So we're going to use 36.50 as a stop. And the obvious target would be back to the previous high, which is 38.25. So what you have is a $1 upside relative to a 70 cents downside. Based on that, you go your risk your reward. And some people don't like that risk reward. I don't really have that particular of a problem with it. I'd like for it to be better. But we're just kind of throwing the numbers off of the chart real quick. And so if I can get to the point where now I've scanned and I come up with this, I have a watch relative to what I'm looking at, and I'm going to put it into play relative to my criteria, which is all derived off of technical analysis right there. Now I've gotten to the point where now I'm ready to trade FXI, but my question still looms is why? What am I looking for? If I'm trading the egg, remember we're trying to make 1% off of the trade, and we want to make it in a week. And so if I can get into the egg at 37.25, and remember we're investing, I think right now around $170,000 of assets that are in the egg, then I'm going to put into this about 4,500 shares. And if I get the dollar trade off of that would be a $4,500 profit, obviously, on the upside. And a dollar on 37.25 is going to be better than the 1%. So it meets our criteria relative to the objective of what we're trying to do. Now, so it meets all the way around everything that we want to do. Here's where the challenge really, to me, comes in teaching and trying to help people manage money. It's actually doing it. In other words, it's fairly simple mathematics and technical and fundamentals. It's the actual doing, I think, is where the challenge really comes into play, and that is that we at some point have to enter the enter key that we're going to buy 4,500 shares. So we're going to actually put a buy order in for 4,500 shares at 37.25. So I have to actually spend, at this point, $170,000 of my money based on what I'm trying to do. Getting there, the actual research part of this, I find that people actually are pretty good at that. What I find that where the rubber meets the road is when they actually have to trade that. And so what they end up doing is they cut the trade. So they say, oh, I'll only invest 500 shares and see how that does. Well, what you've now done is put yourself behind the curve of saying, if my objective is to make 1% on the trade a week, and I only put in 500 shares, and I actually achieve the objective, and I make, say, $500 at the end of the trade instead of $4,500, now I'm off pace of the Y by $4,000. And so what you've done is psychologically start to put yourself behind objective, and that becomes very difficult to deal with. On the other side of it, you put in $4,500, it goes down and it hits the stop at $36.50, and we lose 75 cents a share on 4,500 shares, and we're out $3,200 as a loss. That's where the problem comes in. We worry more about losing money than we do about making money. And until you can actually make that transition where you're more worried about making money than you are about losing money, it's going to be very difficult to actually make money. You have to focus on the objective, not the risk. You can manage the risk. That's why you've got to stop. In other words, we're going to put a stop in at $36.50, so our stop is here, so we know that's what's going to happen. But now, if you don't get into the trade properly, the challenge is how are you going to manage the balance of that to get where you want to be? And that, my friends, is where all of us every day have the greatest challenge. I mean, I listen to speakers all the time talk about trading, and I read people's research, and I log on to websites and listen to people's webinars, and I hear great research. And what I so badly want to ask when it's all said and done is, did you actually trade it? Did you actually put it into practice relative to what you were trying to do? So I want to go back to TAN, which was the egg that we just traded, and I'm going to share with you some of what happens. Now, the entry point on this was 42.30, right in here. So we bought off of the break of this little, so you had kind of a cup and a handle, and then you had a breakout right there. So we took the entry at 42.30 on this trade. And then the trade, as you can see, got up to around 44.80-ish on the high. And we ratcheted up our stop. The stop really kind of got stuck at 43.70 because of this consolidation in here. In other words, I held on to the position because we never broke the regression line. So in other words, I had to take out that regression line for me to really feel negative about the TAN trade. Now, we did all the research the same way we just talked about FXI. We did the same research on TAN, which is solar, and all we were looking for was whether or not solar could get through some of this congestion over here and break and follow through on the upside. And so the challenge becomes managing that trade. And when these bars start vacillating around in this little box right here, we get nervous. And if we have a profit in the trade, we get even more nervous. And if we have a loss in the trade, we're even more nervous. So there's this kind of sweet spot that's kind of break even where everybody's okay with the trade. As long as the trade isn't losing money and we don't have some big profit in it, we're kind of hunky-dory. But when all of a sudden we have a profit in it, it becomes a much more difficult trade to manage. And when we have a loss in it, it becomes a much more difficult trade to manage. And if you've managed money at all, you know what I'm talking about. So how do you deal with the anxiety? How you deal with the anxiety is lessen the number of shares that you own. So in other words, instead of on TAN, we owned 4,000 shares of TAN. You may have only bought 1,000 shares. So what did you do? You lessened the anxiety because the dollar amount fluctuates less and you're more comfortable with that. In other words, it pacifies your anxiety. And by pacifying the anxiety, we're more comfortable with dealing with the trade. But remember what we said at the very beginning of this. Most people, their objective is to make money. In other words, I want to make money. So I set out, I say, I got $170,000. I'm going to put it all into the egg portfolio. And then lo and behold, TAN comes up, it hits the entry, and we say, wait a minute, I'm not sure of this trade. Maybe it's going to go down. We start to question the research. We start to question why we're in the trade or why we're getting in the trade. And so to deal with that anxiety, we lessen the dollar commitment because it makes us feel more comfortable. We at some point have to get over that hurdle, and the only way to get over that hurdle is to practice discipline and continue to increase share amounts or dollar amounts so that we can get to the point. Understand that there are times that when, as a firm, as an advisory firm, that we will invest $15 or $20 million into one position. And when you see those zeros go into the trade and you see that trade get executed, because we trade in a block, when they get traded, there are times even today that I look at a trade and go, that's a hell of a lot of money. That's a lot of risk and a lot of, because I associate, like everyone else, risk with the dollar figure. That has nothing to do with it. Risk is the trade. In other words, if I'm only buying 1,000 shares and I'm only committing $42,300 to the trade versus the $170,000, my percentage of risk or risk of the asset is no different. The risk of the trade remains the same. It's what we potentially think we're going to lose in our minds that changes. In other words, what we're looking at is that if I lose $1 a share on 4,000 shares, I lose $4,000. If I lose $1 a share on 1,000 shares, I only lose $1,000. And on the other side, you only make $1,000 or you make $4,000. It goes back to the why. If you haven't solidified the why, which is why I just went through all of that in painstaking labor, is you got to go back to the why. Why are you here? Why are you looking at this versus this? Because you have not committed to the process. In other words, you thought you like it. You didn't do your homework. You didn't step up to the plate. In other words, what you should have done is say, I'm only going to put $50,000 into my egg portfolio and then do it that way. But don't have $170,000 in the account and only commit 50 of it, because now you start to question, you start to change, you start to do a lot of things that violate the psychology of trading. And believe it or not, as stupid as some of this sounds, it really does impact the end result of how you manage money on a day-to-day basis. So commit to the dollars that you're comfortable with and execute them accordingly. To me, that's where we get in trouble. And when this bar, we posted to sell at 44.15, we actually posted that on this bar right here. And so you could have sold on either bar at 44.15. You could have gotten out of the trade on either day, $44.15. You sell out of the trade. You bought it at 42.30, whatever that is, whatever the profit was, $7,500. I'm good with that. That was, to me, was a good trade. And so now we are 2 days past this trade event. We still don't own an egg. And I get emails from people saying, what's the next egg? Why haven't you posted an egg? Why? For me, where it boils down to is that the market has decided to chop the last couple of 3 days. I don't like choppy markets. I'm much more reticent to invest in a choppy market than a trending market. This is a trending market. This is a choppy market. Know the personality. Know why you're there. Commit to it or don't commit to it. But understand who you are as a trader as you go into these trades, so that when you actually run the scans, you actually build your watch list, and you actually put the trades into effect, that you can manage the positions. Manage them according to what you want to do. Some people sold at 42.60. Some people sold this at 42.50. It doesn't matter to me where you sold it. It matters to me whether or not you understood why you sold it. And it matters to me whether or not you actually understood the process that you were committed to when you took the trade. Now, there was another trade that I've gotten emails about that we posted on the pattern trades on Google. And some people didn't quite understand, why did we trade Google? What made you want to trade Google? And it's a pattern. So if it's a pattern trade, then we're looking at patterns. And, it's purely technically driven. And the trade was driven by this. Google broke off of this bottom. So it had a rounding saucer bottom. It breaks out and it goes higher. And as it breaks out, it hits against resistance. It comes back. So we did trade this, by the way. I traded Google here, and then we got stopped out of Google here. But it traded back, moved up, moved down. So from here, it becomes an A, B, C, D pattern in a descending triangle. So it's very symmetrical. It's very well set up. And so when it bounced off of this low, we said that the entry was 550 on Google. So in other words, we were willing to trade Google from 550 to what we thought would be around 562.50 would be the target that we looked at. Now, if it gets frothy, the reason I like ABCD patterns is that when you bounce off of this support and you get this entry, there's a pretty good probability this is going to break through and run, depending on the personality of, one, the market, and two, the sector. So if we look at this, Google trades in the internet content sector, which is FDN, and FDN was actually trending higher while Google was waffling. So I've got a trending sector inside of a trending market, gives me a high probability trade. It's just pretty much that simple. You could trade Google by buying in the stock at $550 a share. And if you say, well, I only want to commit $50,000 to Google, then you're going to get roughly 85 shares of Google, and you're going to trade out the shares. If it goes up $12.50 on 85 shares, if you have your calculator, you can calculate that for me, but it comes out to $1,062 on a $50,000 trade. And so you take that and you come up with roughly 2% on the trade. And to me, if that's a short-term trade, that's a good deal. I'm good with that. I'm happy with that. I'll take my money and run every day. But if we actually posted the 560 options on the calls, and I think they were the September calls. They were at $21 and some change. And when this broke out and ran, we actually exited the calls. We actually sold the calls at 31 and some change, or 30. I think it was $30.10. Ended up being roughly a $5,000 profit on the contracts. Now, if you traded if you traded 2 on $5,000, it would have been less than that. But where you look at that is you say, why would you trade that? I get a lot of questions as to why I take certain trades. And to me, the questions are very valid, but if you can understand some of the simplicity of some pattern trades, some of them have higher probabilities than others. Some of them have lower probabilities than others. And there's a couple of trade setups and patterns right now, to me, that are very sketchy, and that we're getting some topping formations in the market, and those are things you got to watch out for, which is why I'm not taking a lot of trades the last couple of days. There's been some trades out there to take, but I think the risk of those trades is very high, and that's why you've got to step back and evaluate what you're trying to do relative to what the why is. So, there's 2 trades that worked. Now, we have the other trade that didn't work, and I want to cover this one because I hate to just cover things that work. is that we posted a pattern trade on Western Refinery, and this one was ugly. I mean, there's no way about it. It just was an ugly trade, in that we got into the trade off of this kind of consolidation breakout in here. You can see there was a mid-range, and you got kind of a trading range inside of here, and you get the breakout up here, and I think the entry was 41.25 on this trade, and the stop was back here at around $40.25, if I recollect. And on this bar right here, which if today is Thursday, Wednesday, Tuesday, this bar was like 15 cents above the stop. So we actually held the trade going into the close, and then the next day you get a gap down. And so what should have been about a 1% loss turned into a 5% loss because of the gap on the day. Now, I want to cover this because a lot of people send me emails on this. If we could see, you could see this early in the day. Well, the problem here was Valero. It wasn't Western Refinery. Valero had some bad profit issues relative to refining, and that's perfectly normal when you look at what's going on in that refinery. I don't have time to get into all the whys and hows of what happened, but anyway, Valero came out in the morning and said blah blah blah. Well, Western Refinery, because it's a refiner, gets lumped into that. So Valero was down 9%. Western Refinery was down 4.5%. It gaps down, and you can see it actually even sold lower because it opened up here at around 38.75, traded all the way down to 37. When we see that in the pre-market, we take our stops off. In other words, our stop would have gotten executed right here at the opening trade. I think it was 38.78. We take it off in the event that it will bounce, and you can see that it went all the way down, and it did bounce back. And into the close, we took, actually before the close, it got actually that high water mark, you can't see it very well on the bar because I've scribbled on it, was actually above the open. We sold at around 38.75 on the exit. So we do take the exit prior to the end of the day if it doesn't recapture the stop level. So in other words, it has to go back above the stop. If it doesn't, we sell in the last hour of trading. We just pick a price, we sell the stock, and we get out of it. So we did take a 5.25% loss on that trade on Western Refinery. Now remember that the pattern trade started with $100,000, and it allocates 5% to a maximum of 20 positions within the portfolio. So in other words, it never takes a position greater than 5%. And when it's fully invested, it would have a maximum position size of 20 actual holdings. So if I took the 5% position and I lose 5% of my money on that, so if 5% of that is $5,000, and I lost 5% on the $5,000, then I lost $250 on the $100,000 overall. And my point is to get you to understand that by diversifying, that's the reason we spread the pattern trades out. We take a lot more trades because when you're trading patterns, sometimes things are going to happen that you can't control. One thing that technical analysis doesn't take into account is fundamental data and news. There's no way to account for it, and you're going to get periods where you get a gap, you deal with it, and you move on to the next trade. I mean, it really is that simple because that's the way it works. Where on the other side of this, if we go to Yelp, which was another trade that we had on the pattern trades, and this one was set up right here, and that we had this big kind of wedge, which was more of a flag. It started out kind of as a flag, and it got more of as a pennant. And we bought on this bar, this breakout bar right there is where we actually bought the trade. The next day, that was when OpenTable announced that they were being purchased, and because Yelp's in the same space, they got benefit of that, and Yelp jumped, and so we're still in Yelp as of tonight, we're still in Yelp, and we're up 32.2%. So to put this in perspective, on Western Refinery, we lost 5.6%, but on Yelp, we're currently up 32.2%. So the idea is you want to make more than you lose on these trades by managing the positions, and that's what they're all about. I mean, all of what I'm talking about tonight is position management, and the position management means that sometimes you're going to take losses. I mean, that's just part of the game. When you get into trading and you get into investing, a part of this process is you have to learn to take losses. You have to learn to lose. And when you learn to lose, you learn to win. Because when this gap's open, you learn to hold this trade and ride the trade higher into that. And, I mean, I could put up a lot of trades on here that haven't worked out. I mean, General Electric was one of the pattern trades. And we've had this one for a while. We bought this off of the breakout right in here, and we wrote it up, and then we got, I mean, it was just, what a horrific trade. Actually, the trade was back in here. It's been quite a while further. We bought it back in April on the break out of this over here. So when we bought this trade into General Electric, what we were looking at was this trading range, this ascending kind of triangle in here. We got into the trade, and then we got out of the trade today at exactly the same price we purchased it. And people say, well, why didn't you sell it up here? It was up $1. I mean, it was up 4%. We bought General Electric because we thought we could collect the dividend and watch it go to a $30 target. But it never really materialized, and it was a very frustrating trade. You also had, we own TripAdvisor, which is another pattern trade that we published. And we bought this down in here, and look at the trade. I mean, the trade, we got the entry of the trade right around $88 a share. We're at 107. We still hold the trade. It's up 24% as of tonight's close. And if we can break above this March high, I think it could go even further on the upside. I like Trip. I think it's one of the better companies out there that we've seen. But we bought Baidu on some of the Google news. We bought Baidu on that. That's up 11%. You know, on other trades, we've lost 3%, 2%, 5%. But they all start to balance out over time. And when you get used to that, the losses don't bother you. And so I want to go back. I'm going to pull this over. This is the actual spreadsheet for the pattern trades. And I want to go back to the closed positions. And what I want you to see in here is that when the market gets choppy, the losses are more consistent. You can see right here 1, 2, 3, 4, 5 trades in a row that had negative rate of returns. And, you know, so they get lumped in together. And you can see when the market gets choppy, you got 0, 0, minus 1, 0, 3, 2, 0, 1, 4, 1, 0, 0. So, I mean, you get into choppy periods where you get, I mean, we get our stops up pretty quick. So we get to 0 pretty quick. But what we're looking for, which also takes us out of trade sometimes sooner than we should probably get out of them, but I don't want to lose money. So we manage the risk and let the profits run, because those that sometimes will go down and pop back up are less frequent than the ones that just continue to go down. And so we learn through discipline to put the trades on and hold the trades based on the discipline, not force the trades, not force the exits, but take what they give on a day-to-day basis. And when we get into a trending market, which is what we're in right now, and you can see we got stopped out of Google, or we didn't get stopped out, we just sold Google on a 37% profit. ERX, which is the 3 times energy trade we took, we made 22% profit. You know, and there's the Western Refinery. Actually, I had I'm dyslexic. We were down 6.5% on that trade. But you won't find, when you scroll through these trades, you're not going to find too many 6% losses. The only time you find a loss generally greater than 2 to 3% is on a gap. In other words, some news came out after the market, it gaps below our stop, and then we take a bigger loss than we originally targeted the loss at. And that's generally the only time you're going to see them. On the other side, we're going to let profits run, like with VPS, which is VIP Shop. which is a retail stock that was up 43%. I'm going to let them run as much as I can let them run, and I'll give back some of the top profit just so that I can stay into the trades as long as I possibly can. And you can see we own some trades right now that we've continued. Solar City, Solar got bounced around. We moved the stop enough away from Solar City to hold on to the trade. And all I'm trying to get you to understand is that what you're trying to do is manage these trades on an intraday basis. You can see when we bought Solar City off of the bottoming process in here, we owned it all, and we still own it right now. I'd rather see it run to 87 and hold on to that trade as long as I can to let it run its course. Now, Solar was a lot more choppy than Solar City, but that's the point, is that you want to be able to do it. Now, we tend to take stops, or we tend to take profits a little bit quicker in the egg. I do like this setup for YINN, which is the 3-time bull trade on China. I like the way this set up. I didn't like the gap open today. I really would have liked for this to have closed right around the 26.25 range on the day today. It didn't pull back. I got to look at a little bit more. But if we probably get above 26.83, I like that trade going into tomorrow. And I do think that China runs a little bit based off of all of our research of what we're seeing about China right now. But you're going to have to expect volatility in China just because they're schizophrenic. They lie, they manipulate, they do whatever they can market-wise to better their stocks and to better their position. And you just have to understand that going in. Adding 3 times leverage to the trade makes it even worse, because you get higher volatility off of the trade. And we tell everybody when we post trades like this and you don't want the leverage, go to the unleveraged trade. You can go to FXI. You can trade it by, the charts are identical. They're just different by 3 times leverage. And so take the lesser trade, just don't take lesser shares. Learn to commit the money, but if you don't want the leverage, back away from the leverage. So that's that. Now, with what 10 minutes I have left, what I want to do is I want to go over to the S&P model, because I haven't really covered this model in eons on this website or our webinar. And for those of you who've never really looked at the S&P 500 model, I'm going to pull up my spreadsheet here. That's all the holdings. That's the only things that we can actually hold in the S&P 500 model. We've added a couple things over the years to this, but originally it was we could buy SPY, SH, and the 10 subsectors, so there were 12. I added the volatility indexes. I added treasuries for when there's nothing to buy, and then I added SH, which which allows me to short in a downtrend. So what we have is essentially 15 potential holdings, and that's it. We allocate them. We overweight when we think that the markets are skewed. Right now, I really wish I had about 100% of this into energy, but I really underestimated, I think, the trend in energy coming into the buy on energy. But all we do is we trade within these components, and we can own 100% into one trade or one position, or we can diversify it. Generally, I would tell you that over the 5 years we've had the model, it's pretty well diversified on a day-to-day basis. It does get overweighted when the trends pick up. So the idea is for the S&P 500 model is to make 1% a month and don't lose money, and to basically all you're looking at is U.S. equities. It narrows the research field. And this is a fundamental technical combination strategy. In other words, we're looking at the fundamentals of the market as well as the technicals for entries. And that's how we build them. And all we do is look at those 15 positions every day, and we make a decision. Do we want to own them or do we not want to own them? Do we need to adjust our stops or not adjust our stops? And like right now, we do hold some cash, I think, in this portfolio. And based on the last 2 days, that cash is about to get allocated out of there into healthcare. And we have $7,000 in cash because we got stopped out of our IEF, which was our bond position that we held coming into this last rotation. And you can see it's up 8% for the year. The index is up 6%, so it's essentially outperformed the S&P. We're invested roughly half to 60% of the time the S&P is allocated. So the objective is to outperform the S&P with less risk, and the less risk is created by less money exposed. It's a great model for retirement money. It's a great model for people who don't like a lot of risk in a portfolio because it's very methodically managed and it's very intuitive relative to how it's managed. You can see we hold the positions as long as we can. Some of them have been in here back to March on these trades. Some of them are newer into the May because we had some stops, so we created cash on stops and we reallocated money to financials and consumer services, which are up slightly on right now. So they vacillate back and forth, and so all we're ever looking for is the opportunity based on the S&P 500. And when we run the scans, we're running the scans, as you can see right here, only on those positions. And there's a couple in here that I've added that I need to come out of here. But we added XTL because Spiders finally came out with a telecom position versus IYZ. I do like it. It just has no volume. If you look at XTL, you can see there's essentially no volume. It makes it impossible for us to trade it. And then we also have on our watch list small caps and mid cap, not because we buy them, but because we want to see what they're doing. We have the 30-year bond in here because we want to see what it's doing. So we do track out 24 positions in here just to filter it out to the 15 to figure out where we want to allocate the funds. What are we looking for? What we're looking for when we come into the S&P 500 model is, first and foremost, is we want to know what the fundamentals are of the broader market. In other words, on a valuation basis, is it fair value, overvalued, undervalued, and how do we feel about what the market is fundamentally? In other words, if the PE ratio of the S&P 500 today is at 14.7, do we feel that that's an expensive price to earnings ratio relative to the market today looking forward? Or do we think that it's an inexpensive ratio relative to the market looking forward? I think the market is expensive relative to what we've seen in the first two quarters. Now, based on prognostication from everybody else, it's fairly cheap looking at the second half of the year, but that's also assuming a 3% GDP growth, which I'm not sure we're going to get. We got revised down to 2.9. We're looking at 2% for second quarter. I'm not sure we're going to get there, and if we don't get there, the S&P is going to correct. And so we have to take that into account. So that's first and foremost, is we want to look at the fundamentals. Then secondly is we want to look at the fundamentals of the 10 parts. In other words, there are 10 sectors that make up the S&P 500, and we want to know fundamentally, are they expensive? And one that, we have to look at is XLE today versus XLF. And this is energy versus financials. We think financials is extremely cheap. We think energy is fairly priced. I don't think it's overpriced. I just think it's fairly priced. If crude oil starts to erode away from the 107, 106 range back down to 100, I think that you have valuation issues with energy, and that tends to bother me. And so we tend to lessen our portfolios. Then you've got XLV, which technically is breaking higher. Fundamentally, these stocks are a little bit rich, but I like the technical side, so we'll trade the technical side of XLV and ignore the fundamentals. Right now, that's the way that's setting up. But then you got XLI, which is industrials. We think they're in trouble. You've got XLY, or you've got the consumer, which is, there's a lot of issues with the consumer. You can't have oil prices going up, gasoline prices going up, food prices going up, taxes going up, and everything hammering on the consumer, and everybody believes the consumer is still going to be able to spend. The lower half, I would say the lower 30% of the income producing of the income classes in the United States, the lower 30% are in trouble. Look at Dollar General. Look at Family Dollar. Look at Target. Look at Kohl's. Look at JCPenney's. Look at all the discounters, and they're struggling. Walmart's struggling. Target's struggling. And they're struggling to make earnings. They're doing stock buybacks. They're doing everything they can to get their earnings in line, but they're struggling because that consumer is being pinched desperately, and that consumer is having a hard time. On the other end of the spectrum, you've got the luxury buyers. The upper 10% of income earners in the United States are still spending, and I don't think they're going to stop anytime soon. And I think that side of the retail is holding up the other side of the retail. The middle part of retail is still an unknown, the Macy's of the world. I think that venue is still undetermined as to what's going to happen. So I think you've got the haves, as politically they want to call it, the haves and the have-nots. I want to call it the upper 10% versus the lower 30% are struggling against each other, and in the middle we're kind of treading water. So retail is still a questionable issue. But you start to break them down. I'm getting off track, but you start to break them all down, and then you look at the charts, and you can see XLP, consumer staples, is breaking down. It came back to the 50-day moving average today. I'm not liking anything to do with that. I think if we break below that $44 level, I think that staples has got a problem. But on the other side of this, staples have a problem because interest rates are receding again. This is a dividend sector. But also commodities are rising. The cost of paper, the cost of food, the cost of all these things, gasoline, that impacts consumer staples because they have very thin margins, and you get increases in these venues. It impacts those stocks. And so what we do within the S&P 500 models, we take all of that into account. And we come back and we build the model out of that based on what we see. Like staples, we're probably going to get stopped out of because it's not doing well. Industrials, you got a double top. You broke support lines here, and we're close to the stops on getting out of that. Financials have struggled. You got a double top formation in here. You're coming back to support. You bounced off 2250 today. I think financials are struggling for a lot of reasons, not the least of which is that interest rates are declining again. It makes it very difficult for financials to make money. And, insurance companies struggle when rates go down. Banks struggle when rates go down. And if you look at TYX today, we're back to 334 on the 30-year Treasury. If you look at TNX, which is the 10-year Treasury yield, we're at 252. And, those are ridiculously low rates. That we should see rates going up. Bonds are saying something about equities, and eventually that story is going to unfold. I don't like it, but it's there. But it makes you start to wonder what you should hold in this market relative to what's going on. I like basic materials because when you've got the commodities moving, basic materials are going to move with it. That should lead you to base DBB, which is the base metals. Because they're moving. You can look at SLX, which is moving. On the steel side, it's starting to break out on the upside. You got copper moving right now. It's getting ready to break out above the 200-day moving average. If you get base metals going, you already got precious metals going. We know that gold has broke out, and you see that gold's consolidating. But if that follows through and silver follows through, you're going to get some movement in some of these pieces. All that impacts directly back to how we balance the model out of the S&P 500. So what I want you to understand is that we didn't develop the S&P 500 model to throw darts. We created it to take all the research and boil it down to how do all these things impact the sectors. And that's really the S&P 500 model. And how we manage those positions on a day-to-day basis. XLP happens to be one we own going back to March off of this B-bottom breakout, and now it's starting to break down. And we may have stopped out of it today. I haven't gone back and balanced out portfolios today, but based on what I'm looking at right there, I'm pretty sure that we hit our stop on XLP today, and so we sold the position. And we locked in a nice gain on XLP, and now we'll look for a way to reallocate that money going forward. And that may be to XLV, because XLV set up on a nice trade where you've got a cup and a handle. You can see that you got the breakout here yesterday, follow through today, and I think that you're going to see a little bit more run in that. And things that you want to watch in this space, if you want to break it down, is IHI, which is the medical devices, which are doing extremely well. And I think you want to watch the pharmaceuticals because they're bouncing back with a vengeance. IBB Biotech is moving up very nicely. The one questionable part I have in here is the providers. I think that there's upside in them. My opinion, they're not overpriced, but you've got some issues in here, and that's something that you got to weigh out. But overall, I think when you look at this market today, there are a lot of things that are moving. There's a lot of places to be and a lot of things you can own. But I want to go back to one simple scenario here. It starts with the why. Why are you doing it? In other words, example I used at the very beginning was retirement and making 12%. Well, the S&P 500 model matches against that. And if I go into the S&P 500 model, the idea is to make 1% a month, don't lose money. If I manage that money relative to my retirement account, I'm good with that. That's the objective. Now, I referenced the fact that I've got a daughter going to college. I need to make money. Why can't I take that money and manage it in the egg and generate enough to pay for that college tuition, outside of whatever scholarships and things that she earned, that I can supplement that? And then we go on down the road from that. So it's about managing the lifestyle. It's about managing the whys behind it. And I'm going to conclude with this statement because I want you to think about this going forward. Is the why defines your what, which defines your how. In other words, why we're doing it defines the what we will do, which defines how we do it. If you don't start with the why, the what and the how become a confusing event. So start with the why, which will define the what, which defines the how. And it really, once I got this in my mind 20-some years ago, managing money became a lot easier for me mentally and psychologically. Doesn't mean that it's easy to do. It just means I've got to deal with the parts of it that are there. So the last thing tonight is trade on purpose. In other words, when you trade your money, when you invest your money, you want to do it on purpose. You want to do it based on what you're trying to accomplish every day. It's not a matter of what I think. It's not a matter of what I believe. It's a matter of what I want to achieve based on my portfolio. And that's where every day we have to get focused on what we're trying to do. Now, because I love to read books, I'm going to give you a book that, for me, it's a parable, which when you read the book, it does have a lot of connotations into the different things about, if I can get to the title of the book is The On-Purpose Person. And it's talking. The book is about making your life make sense. And if I could take this book and rewrite it without making Kevin McCarthy upset at me for doing that, I would retitle the book "Trading on Purpose," so that you can make your trades make sense. And that if you really learn how to trade money day to day, it really comes down to understanding why you're in the trades, understanding how you got there. If you got there technically, getting out is technical. If you got there fundamentally, getting out is fundamental. And let the purpose drive what you're doing so that you can be successful at it. Now, all of that said and done, I don't know where the last 50 minutes went because I feel like I just got started. But that as it is, here's where I am, is that I'm getting ready to take a vacation, so because I need a couple days off. We'll be in the office next week and we'll update. Then we're taking off for a week, and I'm not going to update. There'll be no updates to the website other than the tables will get updated. So there won't be a video. There won't be. I'm just going to say that to everybody right now. This is the first time in having the website for 12 years that I'm going to say that I'm not writing anything. I'm not publishing anything other than I will update the open trades that are out there, and I'll update any trade opportunities that we think are relevant going in. I need 7 days away from this just to detox. And then we'll come back on whatever day that is, and we'll start over again. And when we start over again, we'll start webinars back that second, I think it's the third week of July, second week of July, week of the 14th of July, whatever that is. And we'll start coming back into this, and I'm in the process of trying to revamp a little bit of how we get data out to you on a day-to-day basis. And my preference is to get it to you in the mornings before the trading day starts so that you can use it, you can see it, and you have the knowledge of what to do with it. And we've shifted a lot of our updating into the morning. I publish generally by 5:30 a.m. East Coast time. And believe it or not, I am actually up writing at 4 a.m. so that that can get published. But the reason for that is that in the mornings I'm fresh, you're fresh, and you want to use the maximum energy you can to trade, and that's early in the morning. And so we're going to start getting more and more data to you in the mornings and less data in the afternoons. Generally by 4:30 in the afternoon, I'm exhausted, and I think it takes its toll relative to the quality sometimes of the published data. And that's just me. That's my opinion. That's my focus of wanting everything to be better. And so we're going to push more stuff to you in a format that you can use it. And we're going to kind of, some of the enhancements that we've talked about are going to start rolling out after I get back on a lot of this stuff, and we're going to have more videos, archives out there that you can use. And for some of you who just want the education, we're going to provide you a subscription service that you can just get the education. And you can take advantage of all of our archive videos and everything that we've done historically. So a lot of stuff on the horizon. But to me, the most important part of this is that the last 4 weeks has been a culmination of something that I've been teaching for 20 years, which is scan the market, watch the market, play the market, choose your entry, your exit, your target, manage your risk by managing your positions, know where you're going, why you're going, and how you're going, so that you can manage all of those processes not to damage yourself. That's what it's all about. So I'm going to stop there. If you have questions, you can shoot them to me, jim@jimsnotes.com. If you have questions about the website, don@jimsnotes.com. If you're not a subscriber, please look at what's going on in the market, as far as all the things that you want to learn. I know that more of you, the key component of it is that I think, Mike, to answer your question, if you go to tonight's updates, which should be posted already, I think they were posted about 6 o'clock tonight. The answer to what you were asking me for is in those updates more than you will have seen in any prior to this, because I broke down the sectors tonight and talked about what was driving and what isn't driving. So if you pay attention to tonight's update, it actually kind of breaks down. And then tomorrow morning's trading notes, which I've already written part of because we already looked at some of what sector rotation is out there, you're going to see what's driving the sector. So I've actually started publishing a little bit more drill down. If you don't like it, Mike, please send me more information. But Mike's comment is to send you more stuff on what's driving the themes of the market. It's really difficult to do that because the themes are so big, and getting them, by the time I filter them down, I feel like I'm writing a book. But tonight's one of my first shots at trying to filter that down for everybody a little bit, so you'll see a little bit more of that. But I want you to have what you need relative to getting there, and the themes of the market are what help me, and obviously it helps you, and I've just got to find a way to put that into Word format that is easy for me to write and for you to understand. So tonight was one of my first shots of that, so let me know what you think. So with that, you guys have a great evening, great weekend. We'll see you on Monday. And in the next webinar will probably be the week of the 14th of July. You'll get an email on when that's going to be. So we'll see you then.